Hi, welcome back to Ox Talks. It is October 12th, 2023. I'm filming this video a bit earlier today because I need to spend my entire day researching and drafting an opposition to a motion for a client in a real estate dispute case. It takes a lot of time and it's very expensive for the client. Later on in the show, I want to address a couple of ways that, from my opinion, you can try to keep yourself out of court, out of the judicial process, if possible. There's some things you can do. So watch till the end, and I'll spend a few minutes giving you some of my practical guidelines, things that I've experienced over many, many years of being a litigator. But let's first address some of the current events and things I saw that I thought were important to share with you today. The first, we've heard from Jerome Powell in the past saying, "You will feel the pain." And I think it's about time we start taking him at his word. There's an article on the Hedge this morning, which is important. It's headline: CPI hotter than expected. Core remains above 4%. It says, following August's bigger than expected jump, driven by surging energy prices and healthcare methodology changes, September's CPI was expected to slow 0.3% month over month, with the year-over-year pace inching back lower from 3.7 to 3.6 after rebounding for 2 straight months. That was what they were predicting. However, headline CPI came in modestly hot at plus 0.4%, with year over year at 3.7% up. That's the third monthly rebound in a row. It says core CPI rose 0.3% month over month, with year over year sliding to plus 4.1, and that's year over year, as expected. It still hasn't been below 4% since May of 2021, the article says. Under the hood, gasoline, it says, continues to rise while used car prices are starting to drop. And the article goes on to break it down a bit. It says, for all items less food and energy, it rose 0.3% in September as it did in August. The shelter index was the largest factor in the monthly increase in the index for all items less food and energy. The shelter index increased 0.6% in September after rising 0.3% the previous month. The index for rent rose 0.5% in September, and the index for owners' equivalent rent increased 0.6% over the month. The lodging away from home index increased 3.7% in September, ending with a string of 3 consecutive monthly decreases. Among the other indexes that rose in September was the index for motor vehicle insurance, which increased 1.3% after rising 2.4% the preceding month. The medical care index rose 0.2% in September as it did in August. So it says the index, I didn't go through the entire breakdown, guys, I just want to give you a sampling. The index for all items less food and energy rose 4.1% over the past 12 months, with the shelter index increasing 7.2% over the last year, accounting for over 70% of the total increase in all items less food and energy. And it says this is a key takeaway, turning from the cost of things to the ability to pay. Real wages contracted 0.1% year over year after 3 months of being positive. So what that means is real wages are now contracting or falling while the cost of everything else is rising. What does that do to you and I? It puts a further squeeze. You're making less real wages, but you're paying more at the pump and you're paying more at the store. And the article ends by saying this is not the soft landing, cruise lower in inflation that the market and the Fed was hoping for. Another article I saw, this is from Markets Insider, and it's October 11th. And it says, it's titled, "Stocks and Bonds Are In for a Painful Journey, and Cash is Safer," according to top economist Mohammed El Arian. And he's a big voice, I believe a big bond guy. And when he speaks, people usually listen. And here's what he says. Stocks and bonds are in for a rough ride. Cash is the safer option for investors, wary of the latest bout of volatility, according to Mohammed El-Arian. The Alliance chief economic advisor outlined his investment strategy in the current economic environment in a recent podcast with the Financial Times, saying that he'd opted to up his allocation in cash and cash-like assets, which can yield around 4 to 5% for investors, given where interest rates are today. He says, if you are uncomfortable in the stock market, as I am, by the way, then there's a really good place to park your money where you can get paid 4 or 5% on your money, and that will compound, he said on the podcast. Quote, the time will come when I'll be much more comfortable increasing my equity exposure, but I've been quite cautious, he said, of stocks. And just as an aside, I think the same goes to everybody that believes that they're priced out of the housing market. I covered that on a show a few days ago. The reality is there will be a time to start picking up real estate in the coming months and years as all this corrects and starts to crash, which in my opinion it is absolutely going to do. So I think the key here is patience. Be patient. There'll be a time to buy real estate. There'll be a time to buy stocks. I have several friends of mine that they're nonstop buying stocks, and they believe every time there's a pullback, it's an opportunity to buy. I'm a little different opinion. I'm not a stock market expert by any means, but I believe that you want to wait for a serious pullback. And apparently, this gentleman who's very widely followed believes there will be a time to get back or to get into the stock market. He says, slowly over the next few years, we're going back to something more normal, where traditional correlations and therefore traditional risk mitigation come back. I can tell you about the destination, but the journey is really painful, he later added. Stocks and bonds have been feeling the pain as the Fed raised rates and sharply tightened financial conditions. The prospect of higher for longer interest rates sparked a sell-off in the U.S. Treasury bonds, causing prices to plunge and yields on the 10-year Treasury to near 5% last week. Meanwhile, the S&P 500 slumped 20% in 2022 as higher borrowing costs slammed the firms. It says El-Arian has repeatedly sounded the alarm for more economic pain to come. Higher rates can help lower inflation, but they risk pushing the economy into a recession. He says the odds of a downturn increased after yields on the 10-year Treasury jumped to a 16-year record in early October. Another article that I wanted to discuss briefly with you, this is from the AgWeb Farm Journal, and it says high interest rates, strong U.S. dollar take a toll on ag economy. Listen to this, it's very important. We talk about food, getting your food supplies, the fact that cost of food, it continues to rise. Based upon the fact that we have high rates, we have high inflation, and we have a strong dollar. This article says the U.S. dollar is beginning to take a disproportionate toll on rural industries, such as agriculture, forest products, mining, and manufacturing. The challenge for, it says, quote, the challenge for agriculture and other rural industries that rely heavily on global markets is their export partners simply can't afford to buy U.S. products, said Rob Fox, director of CoBank's Knowledge Exchange, in the company's press release. When you combine the loss of exports with a general slowdown in the U.S. economy, it's a double whammy for many businesses operating in rural America. And it says there's some key takeaways from the report. The macroeconomic outlook. Fed officials now expect interest rates to stay higher for longer. That's true. I've been hearing that in the news almost every day. As the U.S. economy outperforms expectations, countries such as Europe and China have fallen short, resulting in the strong U.S. dollar. This makes U.S. exports more expensive and imports cheaper, heavily impacting the rural economy. And then they go into different categories and address some of the issues. I'll briefly touch on those. The first one they talk about is grains, farm supplies, and biofuels. It says historically low water levels on the Mississippi River, higher barge rates, a strong U.S. dollar, and robust export competition from Brazil and Russia are creating major headwinds for the U.S. grain and oilseed exports. It says renewable diesel and other biofuel capacity is also up 26% since January of 2023. Animal protein and dairy. USDA estimates total U.S. beef output will slow down 5% in 2023 and expects an additional 7% decline in 2024. Talks about cotton and sugar. Says cotton production was hindered by ongoing drought, and USDA is expecting a year-over-year drop of 9.2%, bringing it to the lowest level in 10 years. Heading into the fourth quarter, outstanding export sales of all U.S. upland cotton were down 23% year over year. And it says drought's also expected to be an issue for sugarcane producers. And lastly, it touches on oil. We discussed oil in the last couple of shows. It says U.S. crude oil prices increased 30% in the third quarter, with WTI futures rising from $71 at the start of July to $95 by the end of September. It says without greater demand side destruction, transportation costs are likely to remain elevated through 2024. So all those topics, I think, touch on what we've talked about relative to the inflation remaining high. Today's inflation report certainly supports that. So pay attention, keep all this stuff in mind. The last item I want to touch on today from a news perspective, which I think needs to be addressed just briefly. It was an article in the Hedge yesterday. Some of you might have seen it. And it says Hamas leader calls for global Muslim uprising in, quote, Day of Rage on Friday. And it says a screenshot of a video on X, first posted on YouTube, shows Khaled Mashal, the former leader and founding member of Hamas, who allegedly called on Muslims earlier this week to unleash a day of rage on Friday. I believe that's tomorrow. And the article says the possibility that Khaled Mashal's threat is real should concern Western countries. Maybe the threat is real. New York City was placed on high alert Tuesday by New York Mayor Eric Adams, who urged citizens to not underestimate the threat from lone wolf terrorists whom Hamas has radicalized. And the FBI also released an extensive message, I believe, that they posted on X as well. The article concludes with saying the announcement by New York City and the New York City FBI to be extra vigilant for threats is an ominous sign. So I'll leave it at that with regard to that article. I don't pretend to be an expert or even really that knowledgeable on the extent of this conflict, but I will say that there is no downside to keeping your head on a swivel during these times and trying to protect yourself and protect your family. Stay in condition yellow at all times. Obviously, if you're living in a bigger city, a border city, you want to take some additional caution. But just be mindful of what's going on. I had a discussion with this last night, this topic with my family at the dinner table. So it's important. Keep everybody in your family abreast of what's going on. I was watching a video from Patera the other day, and I think she titled it "Stay Strapped" or something to that effect. And wow, that's something you should probably listen to. So it's unfortunate, it's escalating, and we don't want to assume that it's just over there, because it could come here and be here very, very fast. With that being said, I wanted to shift over to the legal stuff. I mentioned at the beginning of the video, I'm working on drafting some motions today, and part of the title of this video is "Stay Out of Court." And I really mean that as someone who makes his living being in court and handling litigation and legal disputes. It's extremely stressful for clients. It's extremely expensive for clients. And in my jurisdiction, when a new case is filed, you can plan on it taking approximately 2 years to work its way through the legal system and end up with an actual trial date. Now, most business disputes, real estate disputes, they don't make it all the way to trial. They get settled usually before trial. And that's because it's so expensive. The costs are so high and it takes so long. A typical real estate dispute or a contract dispute to get to a trial in California could easily cost a client in excess of $100,000. And sometimes it can be a lot more than that. So what does this mean and what's the point? The vast majority of cases I handle that end up in litigation could have been avoided had the parties reduced their agreements, whether it's real estate or business agreements, had they reduced their agreements to a contract. Now, it's very simple. Before you enter into an agreement with somebody, before you lend somebody money, before you decide to go into partnership with somebody to buy some real estate, go to a qualified lawyer and have the understanding, everyone's rights and obligations, who's putting in what money, who's doing what, who's responsible for what. Have that reduced to a proper contract which is signed by the parties. And if a dispute arises, you have that contract to fall back on to say, okay, here's what everybody's obligations are. Look, you can't always avoid something ending up in court, but you can certainly hedge your bets, and I believe drastically reduce the chances of having to encounter and use the legal process and the legal system to resolve disputes. And I will tell you, after 28 years, the legal system is not great at resolving disputes. Private individuals are much better off resolving their disputes outside of court if they can, and much of that starts at the beginning of the relationship. I have so many cases right now on the local dockets of disputes that have arisen between parties based upon handshake, based upon a verbal or an oral understanding. Don't do handshake deals. Don't enter into oral contracts, verbal contracts. Reduce them to writing. There's no such thing as a handshake deal unless you want to end up in a lawsuit and in court. Intentions always start out presumably good, and they don't always end up that way. So go see a good lawyer, get a contract put together, whatever it is. Again, you may be lending a family member a few dollars. You may be buying a substantial piece of commercial real estate with somebody and you have a partnership. It's amazing to me how many really educated people and wealthy people simply do not document their deals, their understandings beforehand. You can't do it after the fact. Also, I wanted to address lastly, in California at least, you don't automatically get an award of your attorney's fees if you have to sue somebody or if somebody sues you and you prevail. In California at least, you have to have either a statute that provides for a prevailing party attorney's fees, or you have to have a written agreement that provides for attorney's fees. If you don't have a statute on point, and there aren't that many necessarily, and you don't have a written agreement, and you have to sue somebody or you get sued, the prevailing party, meaning no one gets their legal fees back. And so you have to give that some thought in the calculation of whether or not it would even make sense to litigate a matter where you don't have a written agreement which contains an appropriate fee provision or a statute on point. So I hope that these tips are helpful. And again, I'm not giving you specific legal advice. I'm not acting as your lawyer. You have to, all the laws vary from state to state, and in many instances from jurisdiction to jurisdiction. So seek a qualified lawyer in your area. But again, this goes back to when you're starting your own businesses. It's exciting. There's a lot going on. It's easy to put the cart before the horse, so to speak. Don't do that. Get your contracts in place. Reduce your agreements to writing, and hopefully you will at least minimize or mitigate you ending up in court where you have a judge in a black robe, or you have a jury who is going to decide what you intended and what you meant, and trust me, it's not always going to be the result that you anticipate or expect or want. So with that being said, everybody stay safe, and I will see you probably tomorrow on the next video. Thank you. Bye.